for the chemical sector because of what's going on between Israel and Iran is going to be on crude, natural gas, and then, of course, how it impacts the chemical sector here back home. But let's also welcome on board Sivaramakrishnan Ganapathi, the managing director at Gokaldas Exports, joining in on the show right now. He's, of course, going to talk about the impact of what really happens within the textile sector here and, of course, Gokaldas in particular as well. Mr. Ganapathi, good to have you on ET now. Let's try and understand what really happens to the Indian textile sector right now. Because earlier, there were expectations that the textile companies here could benefit from the high tariffs between US and China. However, with the recent developments easing out between US and China in terms of their trade relationships, how do you see this playing out right now? And does this mean that China plus one will not work for the Indian textile industry anymore?
I think, United States is negotiating with every country, and, they're negotiating a trade deal with every country, including China. The tariff to China remains higher than tariff to India. And I think India is also negotiating a BTA, bilateral tariff trade agreement with United States. My presumption is that in the end, India will also get a reasonable deal with United States. We have to wait and see as to how much of tariff differential India will have vis-a-vis China. If there is a positive differential in favor of India, then that will continue to help India in gain incremental market share. So we have to wait and see how that happens. In the meanwhile, we're also seeing that UK has entered into an FTA with India, and Europe is also considering an FTA with India. So there are several moving parts here, but all of them are going to be favorable to India as and when it happens. So I'm feeling good about some of these things that are happening, which will be positive for Indian apparel industry, as it will bring down the cost of goods sold from India for our customers. So it's progressing in the right directions in the longer term.
Okay, and Mr. Ganapathi, also help us understand how the company stands to benefit from the UK-India FTA. What is the impact going to be on the company?
The UK trade deal is expected to take effect in about 15 months. That's what was announced. UK imports about 5 billion from China and 4 billion from Bangladesh, which is substantially higher than what they import from India in the apparel sector. And I think once we get a level playing field with Bangladesh, because Bangladesh also goes duty free into UK, we will see some movement of sourcing from Bangladesh to India, as India will also become equally cost competitive. We'll also see some movement of sourcing from China to India, as India will become 12% cheaper than China. So overall, I think I would see this as a minimum $1 billion advantage for India, as India can, get some incremental market share into UK. So this will happen after a year and pan out over the next 2 to 3 years. So it's going to be exciting times from that standpoint. And if this is followed up with an FTA with EU, that will be even better and bigger, because EU is a bigger market than UK.
But along with that, how is the company leveraging India's growing market share in the US and EU markets to strengthen its position and capture new opportunities?
As a company, we are trying to diversify our our markets. We have increased our share of European business, and we will continue to do so. We're growing with our European clients, and we are expanding our relationships with them. Over the next 3 to 5 years, we should see substantial growth in our business from Europe, while the US business will also continue to grow. In the longer run, all of these markets are attractive markets. Garment production will always remain in this part of the world. It cannot continue in United States or Europe, for that matter. And bulk of the garment production will continue in this region. And India stands to have a fairly good advantage in terms of supplying, particularly if FTAs or BTAs are entered into.
Right. And with the capacity expansion plan in Madhya Pradesh, Karnataka, Jharkhand operational by Q3 of this fiscal, what growth are you expecting from the Capex? And if you could just share details on that.
These factories will come up in Q3. We will wait for a few more months before we get a better idea of how these tariff negotiations are going, and then take further call on expansions going forward. Our intention is to continue our expansion, and in the longer run, target 10 to 15% YoY growth, and I think we are on track for that. We will continue to expand our capacities as we speak, particularly in Madhya Pradesh, in Jharkhand, and all these areas where we get, the people availability are good, labor availability is good, so that we can continue to expand. So that's the strategy. These factories will contribute incrementally to the revenue in the next financial year, and that's how we want to see. So from FY26 to FY27, we are planning growth of 15%. These capacities will help in that direction.
So you're seeing your Capex headed and the capacity expansion plans as well. But talk to us about your global order book. How are you seeing order flows from key markets like the US and Europe, especially given that we have global retail softness and inflationary pressures that are at play?
We are seeing a fairly good traction for our orders. We are, from all our principal markets, which are United States, UK, and Europe, we are seeing that all the customers are placing enough orders, across seasons, and we are seeing that traction. So we seem to be confident that order flow will remain robust. Everything is subject to global geopolitics, etc. But subject to that, I think for now the order flow seems to be good, and we seem to be getting good traction.
All right, now talking about the numbers, the company did report a good set back in Q4. So do you expect this growth momentum to continue in FY26?
So FY26, the first half, there may be some challenges, particularly with the 10% incremental tariff which US has imposed on us from April 9th of this year. That 10% tariff, a portion of that would be shared by the supply chain, which includes us. So in the first half, we may have some stress from a margin standpoint, particularly because of the incremental tariff. I think from the second half onwards, the impact of that will be a lot less, and it should eventually get passed on to the customer. So I don't see barring some disturbance in the margin profile in the first half, I don't see much of a problem.
Right. And what about your margins and top line guidance for FY26?
So, in the longer run, we should build upon our margins of FY25, where we were at about 11%. FY26, we may stagnate a bit. In the first half, we may even go down a bit, partly because we have to share some of our, some of the burden of the tariff. We have a particularly high dependence on US market. Almost 72% of our goods go to US, where there's an incremental tariff of 10%. So in the short term, there may be some impact, but in the longer run, I don't see, our margins will start improving from H2 onwards. And the year after, we hope that we will further increase it by 1% or 1.5%.
Okay, so that was the management of Gokaldas Exports. Mr. Ganapathi, thank you so much for joining us and sharing your growth outlook for the company going ahead.